Chamath Palihapitiya is an incredibly successful investor. His investments in Tesla, Bitcoin, and previously Facebook have made him a billionaire many times over. He's also very forward-thinking with an optimistic bent. For example, some of his recent bets over the last few years have included Virgin Galactic, Open Door, and SoFi. He has grand ambitions and he's backing companies with grand plans. So when an optimistic venture investor calls out what he thinks is the biggest risk facing the stock market, a threat that he thinks could definitively blow up several companies, it definitely gets my interest and should probably get yours as well. He's a different type of thinker. He thinks differently than others. So when he calls out a risk like this, I feel like it's important to understand it, or at least to dive deep a little, or to dive a little into it to understand, well, wait a second, what's the actual risk of this happening and how am I positioned to protect myself from this? In this video, I discuss this risk that he calls out, how I think investors can protect themselves from it, and why I personally hope it doesn't come to pass. First, a quick plug, if you will, where my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, that's what I usually focus on, the types of companies that can potentially go up hundreds or thousands of percent over time. Make sure you subscribe. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I'm looking for potential multi-baggers, go to unrivaledinvesting.com, click on Journey. Let's dive right into what Chamath had to say, where here it was, he's tweeting, arguing that the biggest risk correlation to equity markets over the next decade has nothing to do with interest rates. First of all, that's a super interesting call out, because that's a huge variant perception. The market has been laser focused on what the 10-year treasury has done over the last few weeks. As rates have been going higher, it's creating this potentially new narrative fear that potentially the Federal Reserve loses control over the economic cycle and keeping rates low because of huge deficits. Is it possible that rates start just ebbing higher because there's now a supply-demand problem from these spiraling deficits? And so he's actually saying, you know what, I don't think it's going to be interest rates that's the problem. He's saying he thinks that it's going to be carbon tariffs, where he goes, it will be carbon tariffs and it will blow up every DCF model, or discounted cash flow model, of every company in the public markets. Now that's a big call, saying, look, here's this risk that people aren't focused on. It's going to blow up a lot of companies. First of all, let's understand what is a carbon tariff. So when you think of a carbon tariff, it's a tax imposed, it's a tax imposed on imported goods from countries that don't curb, or it's an effort to limit other countries' usage of or pollution of greenhouse gases. So you have China, let's say, use a lot of coal plants to manufacture something, and then you're like, you know what, this is a problem. We want to penalize China for polluting the air, so we're going to put a carbon tax, a carbon tariff on the goods that they, that we effectively import from them, that they export to us, and now it becomes more costly. And this model, the carbon tariff model, is really a consequence or a secondary response to a broader, older concept of the tragedy of the commons, which is a concept propelled by Garrett Hardin, who is a biologist, where the tragedy of the commons is the concept that you have a shared public utility, much like the environment is a shared utility, something that many people enjoy. Everyone enjoys the environment, hopefully, where if you have, let's say, a manufacturer, and in this manufacturing process, you also happen to trash the environment. You're putting up pollutants into the air that can impact everyone worldwide. The cost of producing that good isn't necessarily, and the price that it gets sold at isn't going to capture the full economic cost, in that the cost of trashing the environment doesn't get baked into when you're selling a good, and ultimately the commons gets trash. And so that's the tragedy of the commons. And so hence you need to have some sort of pricing mechanism get involved that sort of balances things out and makes people realize, well, what's the real cost of manufacturing this good, when you factor in that there's these all sort of exogenous costs that go into this picture, these costs, these secondary costs that affect public utilities that you wouldn't expect on the very first level thinking, like, hey, these are the materials it's more than just materials. You need to think about how this was made. Was this made using effectively polluting energy sources like coal plants? And so he continues on saying, imagine a new trade war between the US and China, or imagine an increasingly aggressive European Union fighting climate change. The simplest solution to enact both would be a carbon tariff. So effectively he's saying, look, if you think there's going to be increased trade tensions between the US and China, or the EU gets even more aggressive on tackling climate change. And climate change, some have argued, like Bill Gates has argued, will be the biggest challenge humanity faces in the decades ahead. So this is a super important concept for at least, for folks to at least consider. And he's saying this could be effectively the tool that countries use to address their concerns. And it might be through different approaches. The EU, it might be focused on, hey, how do we make sure the environment, it doesn't get ruined? And for the US, it might be sort of a lever to deal with their growing trade tensions with China. A carbon tariff would require every company to have a detailed provenance of the energy used to produce a good or service entering a border, i.e., you're going to say, what's the makeup of, let's say, coal plants? What's the makeup of clean energy, wind, solar, that you generally use to produce things or produce this item? Depends on how granular and detailed you want to or try to get. And based on that, that should flow through to what the cost of the item is. So he continues, love that iPhone case. Its price will depend on how much coal was burned in China to make it. More coal equals more tariffs equals more costs. Companies aren't prepared for this. Capital markets make no sense of it, or have no sense of it, i.e. it's not being priced in, yet climate legislation marches forward. So he's saying, look, this is a varying perception of his that this risk could get priced in. It's not currently getting priced in. And if it happened, it would really blow up, as he said earlier, blow up the financial models of several companies. The case in point, a cheap goods that are being manufactured in China and exported around the world, and they might just be inputs into a broader system, they would now face higher true cost. They would reflect a higher true cost because we would be putting the tariffs on them to say, hey, you're actually using all these energy sources that are actually net polluters. Let's figure out a way to actually reflect that. The tragedy of the commons model comes up all over again. He continues that we are supporters of carbon tariffs and want to help build solutions. Meanwhile, we update our models, and he makes a face like, yeah, if input costs go way up, that could be a big problem. And just think, it's not just iPhone cases. This taps into a lot of what China is manufacturing, whether or not it's electronics, machinery, clothing, furniture. Higher input costs equals dramatically lower, first of all, revenue and profits, at least in the short term for a lot of companies. This could be very disruptive in the short term. The way to think about it is what sort of impact you could have if you had a structurally different tax rate on different types of companies. What happens if their input costs dramatically change? So while I love clean skies, and I hope you do too, I personally hope these types of taxes don't come to pass. Now, there's a couple of reasons why. So first of all, looking at carbon tariffs or carbon taxes, I think it's a regressive tax. Like if the cost of an iPhone case doubles from, let's say, $20 to $40, that is going to impact lower incomes more than higher incomes. And so it's a regressive tax impacting lower incomes the most. Second, it's very, very hard to do. He talked about having provenance based on, what's your energy calculation and figuring out what's your score. And that is, it is much easier to try to cheat on this and figure workarounds for the system than to actually solve it. And so it wouldn't surprise me, China has been rumored to have many ghost cities. I mean, I feel like if you were to have this, what would prevent them from just creating phantom, clean energy plants that aren't actually in use, but they'd say, oh yeah, look at all these clean plants, and therefore this carbon tax should be a lot lower. So I think they would just game the system. And also, this is another key aspect, and that I think maybe it's not at the speed that people would like, but greenhouse gases are a global challenge, yes. Pollution is very much a local challenge, and because of that, if you look in China, they do have plans for net zero emissions, and you look at a lot of, first world countries are saying, hey, how do we get, how do we, European countries, US, how do we get to zero emissions over time? So this is definitely something that a lot of countries are very focused on, is how do we improve what is actually a local problem in many ways. Now, greenhouse gases are a global problem, but how do we improve a situation like local pollution? And you do it with zero emission solutions, and they do have goals to make it happen. So I suspect that this is something that's better than, let's say, creating a new tax system that can dramatically disrupt and blow up several industries, several companies. But if carbon tariffs were passed, I think he is right about a lot of things. I think there would be a dramatic re-rating. In 2017, after President Trump was elected, the U.S. markets went straight up. It was actually, I think, one of the first times ever that U.S. markets didn't decline by more than 5% in a year, which is incredible if you think about it. There's just the amount of just straight up and to the right. And part of the reason why is it was so clear to people, oh, we are going to have a new tax regime, which meant lower taxes, and how do you revalue these companies? And so it was slowly being digested. Okay, our tax rate's going from 35% to mid to low 20s. That's going to result in a higher valuation and maybe some policies that encourage growth. And so, hey, stock market goes higher. But if you were to have something like this, where you have carbon tariffs, I would expect a serious re-rating, effectively higher taxes. And when you're looking at higher taxes for companies, or higher taxes for their input costs, lower profits, as I already mentioned. But ultimately, these higher input costs would show up effectively as pricing pressures for these companies. And I'd argue that's just another sign or another signal for potentially inflation risk. So, people would start saying, oh, this is actually inflation that's showing up. So yes, he said, hey, I don't think a carbon tariff is as big of a deal as, let's say, interest rates, but I think they're actually married together. If you were to have carbon tariffs, it would actually directly result in higher interest rates over time, because you would have this inflation pressure as the carbon tariffs raise the prices of items. So what should you think about, the risk of tariffs to deal with whether or not it's U.S.-China relations to deal with effectively political tensions, or whether or not it's a response to climate change? If this were to come to pass, what should investors do about it? And so, my thought process is, as I mentioned already, this is the name of this channel is Unrivaled Investing, where I'm focused on trying to find unrivaled companies. And when I say unrivaled, it means you offer a good or a service that you pretty much can't get elsewhere. And when that's the case, it gives you this right to win longer term, because there are other folks that just don't offer the same thing. So each year you either take market share, or you raise prices, or there's just something special about you that enables you to grow year after year. So what I'm looking for is that right to win by trying to find these potentially unrivaled companies. And so ideally they have pricing power, such as, if you do have a tariff that raises your input costs, you have a brand, you have some sort of competitive advantage that allows you to pass through those costs to your end customer, because your customer needs them. Or you just find a company that won't be impacted by it. Maybe it's a software company where it's like, these tariffs have no impact on our business. We're not importing physical goods that are effectively made from coal energy or dirty energy. So there are plenty of examples of companies that could actually just completely sidestep this, or even get stronger from something like this. So let me give you an example, because I'm sure you're curious, like what would I consider a company that could potentially benefit from it? And here it is. I actually called out Facebook a few months ago, back in January. And Facebook, global platform, a lot of people know it, over 1 billion users every day. And so this is a platform that businesses love, because their return on investment is really high relative to other marketing outlets. And so that's actually one of the core parts of the Facebook thesis is that for companies, for the tens of thousands, hundreds of thousands, millions of marketing of advertisers on their platform, they are saying, look, we're trying to figure out how do we acquire customers. They're going to spend money, advertising revenue, to acquire those customers, and Facebook owns the top of funnel, which is very valuable for finding those customers. And so far each year they've been growing the number of users. So it's, the number of advertisements that they can show and to the number of people has grown. And so if you were to have a situation where you have higher input costs and you're saying, oh shoot, well, I'm going to need to be able to pass on these higher costs. I'm going to need to do a price adjustment. Well, what are you going to do? What you're going to need to do is you're going to want to get either better branding so people know about you, or it's going to turn into a price war with other folks. Either way, you need to get the word out that you offer XYZ good. You're going to be spending money on a platform like Facebook. So I would see a company like Facebook actually benefiting over time from something like this, as they are an advertising platform where if you have something like inflation pick up because of pricing pressures driven by a carbon tariff, that actually results in more longer term ad spend, which would result in Facebook capturing a higher piece of the pie. If higher inflation ultimately leads to more earnings power for Facebook. And since I posted this video on YouTube back in January, it's up over 20%. And I also called out that I owned it and that I did like it, and that was one type of example. But there are actually many other different types of companies, potential multi-baggers, like unique healthcare companies. And I've called out a couple of these to these to my Unrivaled Investing Journey subscribers, like unique healthcare companies that either lower their costs or have products that really won't be impacted by it, or have something unrivaled about that where the end patient needs it, so you're able to sell it easily. There's no real risk of input cost inflation that you couldn't pass on to your end customers. Or e-commerce platforms where effectively if the trading partners ultimately on the e-commerce platform say, hey, we need to be able to sell this for a higher price, the e-commerce platform that gets a take based on every transaction, they're gonna win. So there are plenty of ways, potential multi-baggers that could win from carbon tariffs. Whether or not you realize it right away, you might have a big valuation re-rating, but there are a lot of companies that could actually benefit from it over time. That's actually one of the things I try to do with unrivaledinvesting.com journey, where each month I try to call out a potential multi-bagger, a type of company that could potentially go up hundreds or thousands % over time. Subscribers also can see my full portfolio, see what I'm buying and selling each month. It's a monthly update, and any sort of big, material change to my portfolio, I call out as it happens, or approximately as it happens. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey as I try to find these potential multi-baggers, go to unrivaledinvesting.com, click on journey. And if you enjoyed this video learning about what Chamath thinks is the big risk that could potentially disrupt the stock market in the years ahead, please make a point of subscribing. And if you're already a subscriber, I do appreciate that thumbs up. Thanks so much.